Nearly 150 banking and capital markets CEOs from around the world took part in this year's annual survey. Their wide-ranging responses provide valuable insights for our teams into the state of the industry and the competitive challenges that lie ahead. The findings reveal strong confidence in revenue growth. Leading banks are working to put the crisis behind them and moving forward with strategies to take their institutions forward in the new environment. But many banks are still struggling with the remnants of the crisis and the overwhelming increase in regulations and regulatory scrutiny. They have been slow to cut the deadwood from their businesses, making them slow to adapt their strategies and their operations to the new realities in the marketplace. This weight, added to the current market and regulatory challenges, leaves these banks constantly on the back foot. So what marks out the frontrunners? First, focus on the customer. With capital and other regulatory constraints slowing M&A to a standstill, leaders are winning market share with stronger balance sheets and through better products and services. Survey responses indicate this is the #1 priority for growth. These banks are also focused on transparency and winning back public trust. They're also focused on leveraging new technologies that improve service, lower costs, and increase speed to market. Several also commented that leverage of the latest big data analytics to better understand customers and sharpen targeting and cross-selling are also important priorities. The next area is regulation. Given the regulatory pressures on the industry, concerns about public trust, and opportunities to leverage big data, it's perhaps surprising that less than 30% of bank CEOs are concerned about a potential threat from new entrants. Excessive regulation is still seen as the #1 threat to growth, followed by concerns about regional economies. And not surprisingly, CEOs' ratings that regulation impacts their strategy was a close second to customer considerations. We see no let-up in the landslide of regulations ahead. Smart businesses are looking at regulation with a portfolio view to more effectively manage the cost and the strategic impact. Cost reduction and simplification is the next area, with CEOs commenting that the need to reduce costs and more effectively interact with their customers. This is a sea change from the days when growth was surging and banks were rapidly expanding operational capabilities with bolt-on solutions executed in a hurry. Those days have left many banks with convoluted, complex, and overly expensive operating structures that need now to be streamlined and simplified. This is what we have always called finishing the merger. Simplification, wherever possible, could become the watchword, given the required complexity of these new regulations. Most industry leaders rightly see improving operational effectiveness as a top investment priority. Most are also planning to step up cost reduction efforts and change their organizational structure over the next 12 months. But the significant proportion that did not highlight this in our survey's results testifies that quite a few have been slow to take the necessary steps. In a fast-moving market, competitive benefits of operational simplification go beyond cost reduction. Businesses that get this right are going to benefit from greater agility, speedier decision-making, and improved ability to capitalize on opportunities and manage through required changes. The last area I'll highlight from our survey is underperforming assets and businesses. One key component of simplification, and in many ways a crucial differentiator, is the speed with which some banks have exited their underperforming businesses and assets. Cutting out the deadwood has enabled them to release capital and refocus their resources on more profitable opportunities. Removing poor performing assets simplifies the tasks ahead and reduces distractions from regulators. But trillions of dollars of non-performing and non-core assets are still sitting on the books of many banks. Banks that are taking too long to clean up their balance sheets will be competing with one hand tied behind their back. In conclusion, we're seeing a market with multiple stresses. but also considerable opportunities for competitive differentiation. Banks that are actively managing the new realities they face, rather than simply hoping to muddle through, will emerge as the strongest leaders.